Welcome to the Financial Jungle. This is Sharekhan Podcast.
Thank you to all clients, to all participants on the call for this session of Sharekhan Foresight. We are very privileged to have Prashant Jain with us. You may all know Prashant Jain. He's the Executive Director and CIO at HDFC Mutual Fund, India's leading mutual fund. The AMC's assets are over 3 trillion, of which around 1.2 trillion rupees is in equities and equity-oriented schemes as of March end 2020. Mr. Prashant Jain has nearly 28 years of investment management experience. He holds the distinction of being the only fund manager in India and one of the few globally to have continually managed a scheme for over 25 years. He completed his PGDBM from IIM Bangalore in 91. Before that, he's done his bachelor's degree in mechanical engineering from IIT campus. He worked with SBI Mutual Fund between 91 to 93, as well as Zurich India Mutual Fund between 93 to 2003 in different capacities. I'd like to start this call by welcoming Prashant Jain and request him to share his view on the market the way it stands now. And post that, we'll just have a short Q&A between me and him, and we'll end the call. So over to you, Prashant, for your views on the market right now.
Yeah, thanks, Gautam, and a very good afternoon to all of you, friends, and thank you for being on this call. Gautam said I have 28 years of experience, but what we are dealing with is unprecedented. So I don't think long experience really helps in that sense, but I am extremely happy to share with you my thoughts on the economy, markets, and maybe fixed income as well. So I think there are two ways to look at the impact of COVID and the shutdown in India and globally on the Indian economy. One is the external view. How is India's external balance of payments, trade balance impacted? And the second is the view from within, how does the economic growth get impacted? Fortunately, on the external side, India is a net beneficiary of COVID. And that is simply because of the structure of this country. We are large importers of oil, we are large importers of electronics, and our exports to GDP is actually quite small. So especially compared to many other emerging markets. So I think what we say on lower gold imports, lower electronics imports, and above all lower oil imports will be more than what we lose out on the lower remittances, especially from the Gulf, and the lower exports as well. So net, I feel India should save between 1 to 2% equivalent of GDP on the external balance of payment side, and it appears that current year we may have a near trade balance after almost close to 2 decades. So I think externally we are quite well placed, and we are fortunate to be in this country at this point of time, because many other countries that are significantly dependent on all exports or exports of goods, I think will be far worse off, and they will be significantly impacted. Now coming to the one question you may have is, if that is the case, then why is the rupee depreciated? I think the rupee has depreciated because one, globally all currencies have depreciated. Rupee depreciation has actually been on the lower side compared to most other EM currencies. And secondly, in the last 2 months, we have seen almost 20 billion worth of FI sales in equities and in fixed income. And the intensity of the sales has been extremely high. And it is because of these sales that we have seen the adverse impact on the currency. I feel, even though we are not experts in currency, I do feel that whenever the FI selling abates or whenever they actually turn bad, I think currency may recover some of the losses of the last few months. Now, coming to the impact of this on the domestic economy itself, I think it is going to be a pretty challenging environment for the next few quarters for sure, maybe slightly longer than that. India is 60% a service-led economy. 40% of the people depend on services for their employment, and the share in GDP of the bottom of the lower half of the households in the country is 15%. So that translates to a per capita income per household per month of roughly 25,000 rupees. On top of that, in the last 2-3 decades, we have moved from a culture of savings to a culture of EMI-led consumption, so our savings rate has fallen quite sharply. So I think in the current environment, if you look at this backdrop, huge dependence on services, huge dependence therefore on discretionary spends, huge large number of people with low savings and low earnings. So I think, and now companies' profitability will be significantly impacted in several sectors and mainly in service-led sectors. So I think companies, in their attempt to minimize the impact of COVID and lockdown, I think there will be pressures on wages. There could be some layoffs, and the self-employed also will get significantly impacted. So I think, in my judgment, the incomes of a large number of low-income group people will be impacted for quite some time to come. And for quite some time, I don't mean 3 to 5 years, but impact could last up to a year or maybe slightly beyond that as well. This, along with the fact that we just had the Yes Bank restructuring, and that has impaired the ability of the smaller banks to raise liabilities, I think, and given the challenging fixed income or the bond environment also, I think the willingness and the ability of the smaller NBFCs and of the smaller banks to write more small ticket consumption-oriented loans will also be severely limited. And it was this set of NBFCs and banks which had supported consumption for the last several years. So I think this will be an added factor that could impact the economy. And if consumption slows, then it in turn again impacts the wages, because at the end of the day, our economy is like a cycle. Someone spends and someone earns, and then that someone spends, and that is how the cycle goes on. And I think what the lockdown has led to is that momentum in the economy has been broken. And I think there could also be certain behavioral changes which may not be good for the consumption. One, people have realized that it is the lifestyle which was causing most of the expenditure and not living itself. That realization is there, so some people may not feel the need to go out and spend in a way they were doing in the past. Of course, there will be fear and uncertainty about the future. I am told in China the millennials have saved post-COVID for the first time. And finally, there would also be a desire to maintain social distancing. So how many people allow domestic help, how fast into the homes, how many people will postpone painting because they don't want to allow painters to come into their homes, how many people will not visit malls or avoid unnecessary travel or stop or not go out to eat or to party or to meet friends. I think these are all answers we'll know the answers to these questions in due course of time. But at least it is safe to assume that for the foreseeable future, at least some of the people will be more cautious than what they were in the past, and therefore even after the lockdown is lifted, I don't think life is coming back to 100% normalcy in a hurry. It will, we could come back to 80, 90, 95% normalcy, but I think for us to achieve near 100% could take a few more quarters. Therefore, I do feel that the economic impact of this will be there for some time, and it could be anywhere between 6-9 months to 2 years. I don't have estimates for growth for the current year, but economists are suggesting that it should be a near flat year of growth, zero growth. And I think slowly next year growth will come back. I think next year growth could be actually higher because of the sharply low base because of the 6 weeks or so of shutdown in the current year. I think the impact on profits of companies will be mixed, and it will vary from sector to sector. Broadly, companies that cater to discretionary demand and where the fixed cost component of costs is higher, I think these are two characteristics that will impact businesses more. Some of the sectors that could be more impacted than the others, I think, could be restaurants, malls, white goods, brown goods, automobiles, auto ancillaries, retailing companies, garment companies, luxury products. So I think real estate also could be impacted because as work from home gains space and as companies cut costs to maintain profitability, I think the demand for commercial real estate could move lower. It could impact rentals and the values. I think the uncertainty about the future, the cutting wages for white collar, and most companies that I speak to are going to cut wages at the senior levels. So I think that could, and the adverse wealth effect of the fall in stock markets, I think all this could also meaningfully impact the residential real estate market. So I think the impact on sectors, these sectors is going to be quite meaningful. And when the wages are impacted, I think entities that were giving out small ticket loans for consumption or that were giving small loans against property, I think those businesses could also face challenging situations. The good news in India is that the long-term underlying growth drivers of India of good demographics, competitive wages, competitive manpower, rich in natural resources, I think all that remains. And there is one more factor that is emerging very favorable for India, which could work to our advantage over the next few years, and that is the rapid shift away from China as a manufacturing base that is likely. Over the last few years, China was becoming less competitive because of higher wages compared to other Asian countries. So factories were slowly moving out of China. But I think the association of China with COVID, the consequent disruption in supply chains has led to a situation where many companies want to reduce their over-dependence on China with a great sense of urgency. I think this will give India a very good second chance to get back into the manufacturing, which we have missed out the last time around. Our wages are competitive, government is welcoming foreign investments, and compared to other Asian countries, we offer a very large domestic market which will work to our advantage. So I think over time, growth in India should come back, and especially because the external environment is very conducive. Low oil prices, low interest rates, and manufacturing shifting away from China. These are all extremely favorable to us, and I think will put us back on the growth path. But of course, this will not happen in a hurry. But I think starting next year, we should start coming back to normalcy. Coming to the stock markets, I think the market cap to GDP in India has fallen very sharply. And even prior to this fall, we were at 70% market cap to GDP, which was slightly below long-term averages. And this is the first time in my experience when such a sharp fall has taken place in a market that were fundamentally not overvalued. And we have seen the 2008 fall, we have seen the 2000 fall, and those were markets which were very expensive and which fell. But this time around, markets that were slightly undervalued or moderately undervalued have fallen so sharply. And today, as a consequence, our market cap to GDP is touching nearly all-time, or not all-time, but long-time lows. And it is this very low market cap to GDP, the very low price to book value, where Indian markets have bottomed out in the past. We are at those levels. I think this is what makes me optimistic about the stock markets going forward, even otherwise quite gloomy economic environment, because the stock markets typically overreact and they become over pessimistic at times like these. But the key is to think 1 and 2 years ahead. And I think if you think 1 and 2 years ahead, definitely to my mind, we will not continue to be in the current economic situation. We will come out of it and we will be back on the growth path. And that is what gives me the confidence that the current depressed levels of price to book value or market cap to GDP provide a good investment opportunity for those of us who can think medium to long term, and those of us who are tolerant to volatility. Another point here is that if you look at the composition of the large cap indices in India, it is quite interesting. And 1/3 of the Nifty weight is in banks, and this environment is quite supportive of large banks. Large banks should gain share from smaller banks, from NBFCs, and also from the bond markets. So I think definitely even the large banks will have rise in provisioning costs for the current year. But structurally, if you see, whenever the provisioning of the current cycle or the current environment ends, structurally these banks will be stronger. Their market share should be higher than what they are today. So I think some of the large private banks are now available around 1x book value for March 22. The private and the public banks are available a lot less. And so I think there is good long-term value in that space. And I think everyone knows that current year is going to be a difficult year for profits. And therefore the key is to not look at PE multiples, especially for current year, but rather look at more stabler ratios like price to book value. And at 1x price to book for leading private banks, I think that leaves good scope for returns over the medium term. The second sector that is quite large is the oil and gas sector, and the leading company there is Reliance. While we associate Reliance with oil and gas, refining, petchem, the fact is that today nearly half of the value of the company is coming from telecom and from retailing. And I'm sure you have seen what transactions they have undertaken. I think while refining margins are likely to be hit for Reliance, petchem margins are likely to be lower. These are passing phases. Over time, it remains a very competitive refiner. And the interesting thing is that the telecom is one of the very few sectors which is actually a beneficiary of the pre-COVID, pre-shutdown and the post-shutdown environment. So I think there is, I would not say there is deep value in that space in the private sector, but there is reasonable value. If you look at the public sector oil refining and marketing companies, I think they are trading below book values. The marketing margins have gone up, partly to compensate for the lower volumes, partly to compensate for the inventory losses. But I think these companies are, to my mind, quite significantly undervalued. I think next two sectors are software and pharmaceuticals. Software, I think, will have a difficult current year because many of their customers in US and Europe will see erosion in profitability. They may ask for price cuts, they may defer certain projects. But I think this sector is one which helps companies cut costs. It helps companies stay contemporary. And post-COVID, companies would want to invest more in their systems, processes, working out of home, moving to cloud, etc., higher automation. So I think this is one sector which remains very relevant in a post-COVID world. And I think that from next year onwards, this sector should come back to near normalcy, though current year analysts expect about 5-10% degrowth in this sector. Valuations again are quite reasonable, and the dividend yields on some of the leading companies is between 3 to 5 or 3 to 4%. So that again I think is a sector which is reasonably well placed. Pharma, I am sure you would agree the impact is minimal. There could be some impact because of supply chain issues for a quarter, but medium to longer term, I don't think there is much impact on that sector. The next sector, large sector in Nifty, is the EPC companies like Larsen & Toubro. While industrial capex will get hit because as companies try to conserve cash, they will push out any non-essential capex. But I think the infra projects, which is what primarily comprises the order backlog of companies of EPC companies, I think the order backlogs are quite reasonable. And I think these companies should come back to a near normal operating environment next year onwards. Current year, of course, profits will be down because for 2 months your site overheads, your corporate overheads have been incurred, but you have not billed. And these companies again are trading close to all-time low multiples, both in terms of price to book and in terms of fee multiples. So I think there is reasonable value in that space as well. The next sector is the utility sector, and this is an interesting sector. And while it has been an underperformer for quite some time, and I think the sector has come to levels which are close to all-time lows, lifetime lows. Many of these companies are trading below book. The dividend yields are from high single digits to low double digits to in some cases even mid double digits. Low teens dividend yields. So I think this is one space where the impact of COVID will be minimal. And I am told that in Maharashtra, the peak power demand has gone up because as more people are working from homes, the air conditioning requirements have gone up sharply. So that is one unintended consequence of higher work from home, that the power bills could actually go up. And companies like TCS are planning to make a higher proportion of work from home the way forward. And if that happens, I'm sure the power demand will go up, which in any case is low in this country on a per capita basis. So this is one sector which is not impacted by COVID, and the valuations are actually quite interesting in that space. That brings me to the last two sectors, and one is the FMCG and the other is the automobile sector. And I think automobile sector will be very hard hit along with the white goods and brown good companies, and it is very difficult to foresee the earnings in the current year because this is a sector where the fixed cost is quite high, and a 20, 30, 40% downturn or a fall in volumes can have a disproportionate impact on profitability. The FMCG sector, I think many people feel that this earnings will be very resilient. I have some doubts around that because the definition of a discretionary product is not uniform from the low income groups to the higher income groups. For a higher income group person to spend few hundred rupees on a bottle of shampoo or an ice cream or an expensive chocolate or a cream biscuit is okay. It is a non-discretionary purchase for them. But for someone who is earning 15, 20, 30, 40, 50,000 rupees a month, these become discretionary spends. And in this current environment where a very large number of people will see their incomes impacted, I think there will be measurable impact even on these companies. And it is the real discretionary products which have higher gross margins. So I would feel that there should be decent impact on the profits of these companies as well. Though as I said earlier, since this is a very first time kind of an event, so whether you have 5 or 30 years in the market, it really does not give you an advantage in that sense. So it would be very interesting to see how things play out in the current year. Net, the message I was trying to give is that if you look at Nifty, given the composition of Nifty, which is dominated by large banks, which will benefit in the medium term, it is IT and pharma and metals, which are global commodities. They have less, the local economic conditions do have some impact, but again, it's a transient impact. The utility companies are not impacted, and oil and gas again and telecom are either low impacted or have actually benefited. The weight of the consumption, discretionary and non-discretionary, is under 20%, and in Nifty at least, and that is what makes me optimistic given the low price to book values and the low market cap to GDP of India on the stock market. Many people find this very confusing, that when economy is in such bad shape, how can markets recover so much? I think while in the near term, markets are always volatile and it is very hard to say, but if you think longer term, I think there is good value in these markets. If you assume that over the next 6 to 18 months, we will come back to near normalcy, then I think this market offers very good prospects, especially in the large caps. I think I would prefer large caps at this point of time because one, they have borne most of the brunt of selling, and that is where the first bounce should come. And second, the structure of the sectoral distribution of mid caps is such that most of the businesses that will get impacted are in small mid cap space. For example, the NBFCs, the smaller banks, the white goods, the brown good companies, the retail chains, the hotels, the multiplexes, the malls, the auto ancillaries. These are all sectors which, because of the nature of these sectors, are in the small mid-cap space, and therefore I feel the impact on profitability of companies could be slightly higher in that space, and therefore one should be a little more cautious. I think what could investors do in this environment? I think one, it highlights, while this is once in a 10-year, 20-year, once in a lifetime kind of an event, it does highlight once again in a very painful manner the real nature of equities, and why we always say that never borrow and invest in equities, and always think long-term in equities, and invest only that much in equities where you can tolerate volatility and hold it for long periods. So that is, I think, the one key learning of COVID, that how risks can manifest or come out of completely unexpected situations. That is point number one. Point number 2 is that if you look back in the past, it was the severe corrections in the markets around events like these 9/11, Lehman, Brexit, tapering, Asian crisis, whatever. And when FI sold very large amounts in Indian markets, if someone invested in those corrections, they gave significantly above average returns. And I don't see any reason why that should not happen this time around as well, especially given the fact that the external environment for India is actually very, very supportive. So I think all of us should assess how much is that portion of our wealth which we can spare for medium to long periods, on which we can tolerate volatility. And if we have a surplus to invest, I would suggest that we should invest that in large cap oriented funds primarily, and we could invest that over the next 2 to 3 months in 2 or 3 rounds. One round we should invest currently, because markets have come off very sharply, and the current market cap to GDP, price to book values, such ratios are seen once in a while only, and we should deploy some money around these levels. Second round we could contemplate when we are getting as a country, we are getting a better sense that lockdown is being lifted and COVID is coming under control. The third round, I think we could invest, and this is for if you are really conservative, you could invest after the markets have seen at least substantially the current quarter results, because they will be close to the worst results for quite some time. In my judgment, I have seen when result expectations is very low, markets bottom out ahead of the results, but you never know. So maybe around you could invest around June, July or August. So this is what I wanted to share with you, and I hope it has been useful. And let me now request Gautam to ask any questions that I have not addressed in the...
Yeah. Prashant, thank you. I was listening intently and going through the questions I had prepared. There were 8 of them, and you seem to have covered most of them. Just a couple of aspects where maybe you can shed a little more light is obviously on the debt side and its contagion effect on the equity markets. So we saw the credit issue with IL&FS and DHFL, and now we've seen what's happened in the credit funds as well. So I just wanted to understand, and obviously our clients also wanted to know, how is this going to impact equities? And, where will this, let's say, people withdrawing their funds and staying away from high credit papers, how will that impact the equity market?
One, I think what has happened to a peer fund is, while it is very painful for many of us and even for the other industry participants, I don't think it is right to extrapolate that fear into other funds recklessly. And we have seen similar events in the past, and I think at least for us, I can speak that we have always been cautious on fixed income investments, and we follow SLR, safety first, liquidity second, and then returns, simply because on fixed income the rewards for extra risk are very small, 0.5%, 1%. So I think I hope this does not become a contagion, and the size of credit funds itself is quite limited. It's about 50,000 crores very roughly, and that is not a very large number. So I think things should settle down unless there is some unforeseen development. So that is a general expectation. I feel that things will settle down, but you never know. Now coming to your question, how does this impact equities? Actually, in a way, I addressed it because this is similar to what happened to Yes Bank. And what does this impact? It impacts basically small NBFCs or NBFCs which the liability franchise is weaker, impact smaller banks. They will like to slow down growth, and you can see banks are coming to raise additional equity capital to prepare for a bad environment, a difficult environment. So it could lead to lower return on equities for these financial entities for some time. I think it could also impact discretionary consumption because when, as I said, large banks will gain share from smaller banks, NBFCs and bond markets, and it was the smaller banks and NBFCs who were financing the small ticket consumption oriented loans. So I think the discretionary consumption could stay subdued for a while longer, and this is one area, this is one reason why in my opening remarks I emphasized that consumption in India should take a while to revive. So these are some of the sectors that could get impacted because of this.
Right. Thanks, Prashant, for that. I'll just ask one last question. What would your advice or guidance be to someone who's new to the market, who's just starting out, going to build their portfolio now? What would you tell them to do? Obviously, you mentioned the 3 stages of investing, some amount today, wait for news to break. But what would you suggest to them? Do you think they should start immediately, given the valuation?
First of all, I would congratulate them that they are incredibly lucky.
Right. Yes.
That people who are starting their investing careers at times like these are once in a, not once, but maybe 2-3 in a lifetime kind of an opportunities. And right. I have seen time and again, and it is well documented in investments, that the best investments in life are made in the most difficult times. Because right. It is in the most difficult times that you get the best valuations. If you invested post-Lehman, post-9/11, post-Brexit, you bought the same businesses much cheaper, and therefore over time you made that much more money. So I think those who are just starting out on their investment journey are extremely lucky. And because please remember, today if you look at the Nifty returns for last 10 years, they are in mid-single digits. So someone who has been invested in equities for 10 years has barely earned inflation. Markets are so cheap. India's market cap to GDP is near 50%, which is very low. So I would say for someone who is investing in equities for the first time or starting out, it implies that your exposure to equities is very low. And also for most of such investors, it implies that they are quite young. So you have time on your side, and you have the risk-taking capacity on your side. So I would say for such investors, they should make the most of these times. Such times don't come every now and then. And to the extent of their risk profile, to the extent of their risk capacity, they should invest in equities, because longer term equities do create 4, 6, 7, 8% more CAGR returns than fixed income, despite the experience of last so many years where returns have been low. I think equities do create that extra wealth, and over 10, 20, 30 years of 4, 6, 8% extra return, it makes a big difference to your wealth. So that, and what to buy, I'm sure Gautam and his colleagues would do their best to advise you which funds, what vehicles, what stocks, what sectors.
Right, Prashant, thank you so much. On that positive note, I'd like to thank you once again for taking the time out and talking to our clients. Thank you all, to all participants, to all clients for attending this session of Sharekhan Foresight. I'd like to thank Prashant as well as HDFC AMC for partnering with us, and hopefully we will continue to address your queries, and hopefully we'll all continue to generate good returns as investors. Thank you all.
Thank you all.
Thanks, Gautam. Thanks, Prashant.
Sharekhan's in-house research desk may or may not subscribe to the same views and may have different recommendations to offer. Statistics mentioned during the session have not been verified by Sharekhan. This conversation is for educational purposes only. The information and views shared herein is not intended to be and must not in isolation be taken as the basis for an investment decision.